Quick, what's your favorite investment? Me too, the one we get to keep the most of. And how do you know if you're keeping as much of it as you should be? Well, if I could hear you, I'm sure you'd be saying knowledge and careful planning. Too often, we're missing out on additional investment returns because we are creating costs and drag on ourselves, and this leads to diminished lifetime returns. While completely avoiding tax is nearly impossible, an understanding of tax planning strategies can help us to reduce tax drag. Asset location is one of those strategies, and we're going to cover 4 big keys to what can make it effective. Hey everybody, I'm Curtis Crossland of Subtle Crossland Wealth Advisors, and I help folks build more tax-efficient retirements. Now, before we get into our keys, we need to have an understanding of what asset location is. Asset location is a strategy that focuses on placing different types of investments into the accounts that provide their most tax-efficient returns. In essence, we want to maximize our net after-tax returns in our lifetime. Remember, it's not just what you make, it's what you take. So let's get into this. The first big key we need to understand is the different tax treatment of various accounts. And this matters because how our investment returns are treated can make a big difference in what they will ultimately produce for us after tax. Starting with tax-deferred accounts, investments defer growth, dividends, and interest until assets are withdrawn. Examples here are any pre-tax retirement accounts. This includes 401ks, 403bs, traditional IRA, SEP IRA, simple IRA, etc. Money typically goes in on a pre-tax basis, meaning income may be deferred. This might save you on income tax now with the idea of paying income tax later on everything including returns. Tax-free accounts. These are accounts that grow tax-deferred and ultimately tax-free when specific conditions are met. Examples here are accounts like Roth 401k, Roth 403b, and Roth IRA. These accounts are funded with after-tax dollars with the intention of providing tax-free withdrawals later, including any earnings. Then there's taxable accounts. We realize capital gains, dividends, and interest, and pay applicable tax in the year earned. Examples here include taxable brokerage accounts, bank accounts, and money market accounts. And then there's other distinct accounts that are more goal-specific, like HSA or 529. These could provide certain tax-free benefits based on their qualified use, but could have a penalty on top of taxes if distributions don't follow IRS guidelines. And what about life insurance contracts like annuities and permanent life policies? This isn't an exhaustive list of all account types and treatments, but the point is that understanding the account types that are applicable to your situation and how they're going to affect our investments requires careful consideration. Asset location, then, is a type of unifying strategy that attempts to reduce lifetime tax drag across your spread of accounts. I did a video on tax planning that you can check out if you want to get a better idea of how things like asset location factor into the big picture. The next important key is to understand the tax efficiency of investments themselves. Ask yourselves this: which investments primarily work towards interest? Which work towards tax-free interest? Which work towards dividends? Which work towards gain? And which may provide a combination? And then how are these different returns taxed, now or later? With stocks and stock funds, you can realize gain and loss, and you can also receive dividends. But within those outcomes, you can experience different treatments like short or long-term gain. You can also receive normal or qualified dividends. This means you can experience different tax effects. Normally, long-term gains and qualified dividends are preferred because they can mean lower tax drag. With things like bonds, CDs, and money markets, you're receiving interest. This is going to be taxed as normal income unless they're specifically tax exempt. Not all investments have the same goal or objective to minimize the amount of taxes paid. Take, for example, an equity index fund or equity ETF. These are normally considered tax efficient since their goals are to avoid capital gains distribution to shareholders, as well as deliver more qualified dividends. This is in contrast to higher turnover active funds that have a total return objective, irrespective of any individual or institutional tax concerns. So even if you have alpha on active positions compared to passive, if the tax and trading costs to support that investment strategy creates a lower net after-tax return, which actually outperformed? Let's revisit and think about bonds and bond funds. While gain and loss can happen, the primary return objective of bonds is interest, which will also be taxed as normal income. Regardless of where you place a bond fund or ETF, you won't be earning qualified dividends. And you might think, I can just use tax-exempt bonds, but they may not be saving enough in taxes to outdo normal bonds that may pay better than a tax equivalent yield. By understanding the tax implications of investments and then combining that with what we know about the different tax treatments of accounts, we can start to determine the optimized place to hold or shelve them in our own accounts. But there's more to the puzzle. The next big key is understanding placement. And this brings up an interesting question. Is there a general approach or rule of thumb to shelving different investment types? Well, looking at a 2022 Vanguard research paper, they suggest that in general, placing bonds first in traditional IRA, then Roth IRA, and then in taxable accounts is the optimal asset allocation strategy for most clients. However, the preferred strategy for some investors with conservative asset allocations may differ if no step up in basis is assumed and active equity is incorporated into the portfolio. They also conclude by saying that heavy spenders may find it preferable to locate equity in Roth IRA accounts and shift some of the bond allocation into taxable accounts. The paper is worth the read, and I've linked it in the description. An understanding of general placement should also come with an understanding that there is no one-size-fits-all. There are going to be situations where taxable balances are small and deferred balances are large, or vice versa. And what about ultra-aggressive allocations versus very conservative? Each situation is going to be unique, and finding the optimized location is going to be situationally dependent and require reviewing several different factors. This can get very nuanced based on each investor's asset allocation, time horizon, objectives, account types, and sizes. But if the goal of asset location is to ultimately reduce lifetime tax drag and increase net after-tax returns, getting smart about where we're placing those investments has the potential to make a difference. The fourth big key is understanding how this fits into your bigger picture overall. Having your investment strategy coordinate with your financial plan seems obvious, but it's still worth discussing. Financial plans consider what you're doing today, but they're forward-looking. They're also a process and continue to develop over time as your life changes. What you're working towards should be a reflection of what you want to get out of life, the experiences you want to have, and how to share that with people you care about. This also means plans can change, and this can impact placement depending on spending needs and time horizon. Think retiring early versus working until you drop dead and leaving every penny to family. Someone looking to buy a house in 2 years and start a family is going to have a very different need on their growing assets compared to someone looking to finish out their career in 10 years. And this is going to be very different from someone looking to finish out their lifetime in 10 years and deal with legacy. Asset location should coordinate with your ever-developing plan and life needs. This can also mean being cognizant of current and potential future tax brackets. This might mean having a different approach to general placement heuristics or executing tax arbitrage strategies at different stages of life. Perhaps you haven't even considered retirement, but rather have a general focus on building lifetime wealth. Even if you have a very hazy idea of what your retirement and future look like, having a mindset of optimization in spite of uncertainty or ambiguity can still work to serve your lifetime tax efficiency. The point is, we may need to adapt our asset location and approach to our long and winding roads. Considering your plan is going to aid that decision making. Asset location can be an important tool when it comes to tax planning. The amount and variety of accounts that we can accumulate on our journey towards retirement can increase with age. And so too will the importance of proper asset location for each situation. The earlier that you learn and adopt this strategy, the easier it can be to implement and adhere to it. It's also never too late to start incorporating this into your portfolio if your situation allows it. As always, if you don't know where to start or what to do, seeking the help of a qualified and licensed professional can be a good starting point. Stay diligent in your planning and don't neglect strategies that work towards reducing lifetime tax drag. Once more, I'm Curtis Crossland of Subtle Crossland Wealth Advisors, and if you want to see how we help folks build a more tax-focused and efficient retirement, be sure to check us out at www.subtlecrossland.com and subscribe for future videos.